All right. So I'm going to take this opportunity and discuss question number 2 on your chapter 7 homework. All right. And this is another financial planning model problem. And actually, um, it has 5 different parts and is trying to add a few more tweaks, somewhere here and there. All right. So let's see how we can actually, solve this model here. And this again is the value driver assumption and financial policy assumption. And this time, I actually want to go a little faster. So instead of manually putting down all the assumptions here, I'm just going to look at the income statement and the balance sheet. Right. So year 0, and this is year 1, and I have um, 5 years here. Okay. Um, and then I'm going to look at the income statement. All right. And the first item is sales. Okay. And for the year 0, the sales is actually 1,000. Okay. It's good. We're dealing with very small numbers. And then you have cost of goods sold. And this actually is 500. Okay. And we have interest on debt. All right, so this actually is 32, and you have interest on cash, and this is actually 6. Okay. And then you have the depreciation. All right, this is annual depreciation. This is 100. And then you have the profits before tax. Okay, so I'm just going to do this here. Sales minus cost of goods sold minus interest you pay on debt plus interest you earn on cash, and then minus depreciation. So yes, you're going to have 374. And then you look at the tax. So tax is actually 374 times the tax rate, which is 40%. So I'm just going to put down 40% here. Okay. Now, if I do that, I cannot model the impact of the tax rate on the valuation numbers. All right. Actually, not tax rate, but tax. Okay. So let me just correct that. And then you have the profits after tax. Okay. So that's going to be 374 profits before tax minus 150. Right, so that's going to be profits after tax. And then you're going to pay dividends to shareholders. And so you have 224 multiplied by 40% dividend to payout ratio. And therefore, you have retained earnings for year 0. And that's going to be equal to your 224 minus the dividend you paid out. So that's 134.64, which is 135. All right, so that is the income statement for year 0. And now let's move on to the balance sheet. Okay, so you have cash and other marketable securities. This is observed. This is 80. All right, and then you have current assets. All right, and this is actually observed at 150 for year 0. And then you have fixed assets. And you have the same 3 items here: fixed assets at a cost versus total depreciation versus net fixed assets. Oops. Net fixed assets. All right. So these numbers are all given: 770, and the total depreciation is 300, and therefore the fixed assets at a cost is going to be the summation of these 2 numbers. All right, $1,070. And so you can look at the total assets, which is the cash plus the current assets plus the net fixed assets. So this is 1,000. All right, so now I'm going to look at the liability and the equity side. So current liabilities, all right, this is observed at 80. Okay, and then you have the debt. So the company does have debt as well as cash. Debt is actually 320. And you have the stock. which is actually 450. And then you're going to have the accumulated retained earnings. So that's going to be 150. And therefore, you can now have total liability plus equity. So I'm just going to add up all these numbers, and they should be equal to total assets. Yes. So this balance sheet is balanced. All right. So now we're going to model what's going to happen in year one. All right. First of all, I'm going to look at the sales growth, which is actually the previous year's sales multiplied by 1 plus sales growth, which is 10%. Okay, so I'm putting down 10% as a constant. If I need to model the sales growth rate, then I would have to devote a separate sales for the sales growth rate and use the cell reference. All right, cost of goods sold, and this is actually assumed to be 50% of the sales. So I'm going to do that multiplied by 50%. And interest on debt, so that's actually 10% of the average debt balance. So I'm going to do 10% multiplied by the average debt balance. So I'm going to have debt for year 0. I'm going to have debt for year 1. And that is the average debt balance. All right. And then interest on cash. So that's going to be earning 8% interest on the average cash balance. So the cash for year 0 plus the cash for year 1. And that is 3.2 for the moment. Those numbers will change, as you have seen. Depreciation, this is the depreciation in year 1. So that's going to be the depreciation rate, which is 10% given, multiplied by the average fixed assets at a cost. So I'm going to look at fixed assets at a cost for year 0 and fixed assets at a cost for year 1. And so I take the average, and that's 53.5. So the profits before tax is going to be the sales minus the cost of goods sold minus interest you pay on debt plus interest you earn on cash minus depreciation. Okay. All right. So that number is good. So can I just copy this down here? Yes, this is good. So this is good. And this is good. All right. So I can just copy across, and let me just take one and a double check. All right. So that is the year 1 for the income statement. Now the balance sheet. So this actually is I'm looking at part A here. So cash is the plug, right? Yes, in part A, B, C, D, cash is the plug. In part E, debt is the plug. So I'm just going to look at part A here. All right, so cash is the plug. I'm going to move on to current assets. Current assets, that is 15% of sales, 15% of sales, okay? All right, so I'm going to look at the total depreciation. So that's going to be the total depreciation as of the previous year plus what you have depreciated this year. All right, so net fixed assets, this is saying it's 77% of sales. So I'm going to do 77% of sales. All right, I just want to work fast, so I put down all the numbers as constant. So the total assets, I'm going to leave this blank because I know I'm going to manually balance the balance sheet. All right, so current liabilities, that's going to be 8% of sales. So I'm going to do 8% times sales. Sales, all right, so that is the current liability here. And debt, what do we assume about debt? So debt is, what does this say about debt? The debt and equity remain the same, right? So I'm just going to build a little formula here. That's the debt and that's the equity, right? So I'm going to copy this across for 5 years down the road, right? And I'm going to look at total accumulated retained earnings. So that's the total accumulated retained earnings as of last year plus what you can accumulate this year. All right. So now I'm going to actually look at the total liability plus equity. Yes, it seems like I copied this across. All right. So I'm going to solve cash as the plug, and cash as the plug. That means By the way, there's one thing, that's actually not, completed. So let me just finish this part. Total, the fixed assets at the cost is equal to total depreciation plus net fixed assets. All right. So, and I also need to solve cash as the plot. So I'm manually balancing the balance sheet. All right. And now cash is the plot. So this is equal to total assets minus current assets minus net fixed assets. Okay, so all the numbers, they've changed. So I have 1,155, and that is the total liability plus equity for year one. And yes, that is the correct answer. So I'm going to copy all these across. All right, so copy all this across. And I also need to copy these across. And I'm going to copy these two across. Okay, so yes, all the numbers are solved. So let's now look at the valuation exercise. So I'm going to make the timeline here again. And this is now calculating the free cash flow per period. All right, so I'm going to have this infinite timeline now, even though we just predict the cash flow or the financial statements in the following 5 years. So the first item is profits after tax. So that's going to be the profits after tax for year one, which is actually in the income statement. It's in row 11. Okay, so let me copy this across. This is only for 5 years. Now let's look at the next item, which is actually depreciation. We need to put back depreciation. So let me just put back depreciation here. This is the annual depreciation. So it's from the income statement. It's in row 8. Okay. So that is the depreciation. So 116, and copy this across. And we also have the increase in current assets. All right. So these are actually doing the formula in our textbook. So this is going to be current assets in year one minus current assets in year 0. All right, so that is 15. Let me copy this across. Okay, and let's look at increase in current liabilities. All right, so that's going to be equal to liability in year 1 minus liability in year 0. And I have $8 here. And let me copy this across. And now I need to look at increase in fixed assets cost. All right, so I'm going to do fixed asset cost for year 1 minus fixed asset cost for year 0. So that number is 193. And let me copy this across. Okay, and we do after tax interest cost on debt. Oops. All right, so that's going to be, again, the after-tax basis. So 1 minus the tax rate, which is 40%, multiplied by the interest you paid on debt, which is actually in the income statement, interest paid on debt. So that is 32, and so that's 19.20. And let me copy this across. Okay, and let's do after-tax interest on cash. So I'm going to do, again, 1 minus the tax rate, which is 40%, multiplied by interest you earned on cash, which is actually in row 7. So, all right, and let me copy this across. I have the after-tax cost of interest. Okay, all right, so I'm ready to calculate the free cash flow, and this is equal to the profits after tax, put back depreciation, minus increase in current assets, plus increase in current liabilities, minus increase in fixed assets at cost, plus after-tax cost of interest on debt, minus after-tax cost of interest on cash. So that's 175.9895. Copy this across. I get the free cash flow for the other 4 years. And now let's look at the free cash flow growth rate. And this is saying the free cash flow growth rate is going to be, what does this say? The free cash flow growth rate is going to be the same as the sales growth rate. This is actually the question, so it's going to be 10%. Okay, so it's going to stabilize at 10% starting from year 7. So I can copy this across. All right, so now based on this, I can calculate what is the free cash flow in year 6. So this is going to be the free cash flow in year 6 and onwards. Okay, all right, so now I can actually apply the Gordon model partially. Starting from year 6, okay, I look at the free cash flow and I divide that by the weighted average cost of the capital, which is 20%, that's given, minus the constant free cash flow growth rate, which is 10%. All right, so that's the terminal value. And therefore, I can look at the cash flow per period. So that's going to be terminal value plus the free cash flow in the last period. And this should also remind you of the resale price plus the last dividend, or the principal amount plus the last coupon. So I'm going to do the enterprise value here. And this time, I'm going to use the Excel NPV function to calculate the present value of future cash flows. Discount rate is 20%. We have all these cash flows. Okay, so that's $1,597.90. That's going to be the enterprise value, which is actually the answer. And so I can now look at the market value of equity. And so this is going to be equal to enterprise value minus debt. The debt in year 0, 320 plus cash, the cash in year 0, which is 80. So that is market value of equity. It's 1,357.90. All right. So this is part A. So let me just say number 2, part A. Okay. All right. So we're just done with part A. And we did this in a bit of a hurry because I don't want to make this video too long. Or if I make the video too long, some of you may actually be intimidated and don't want to watch it. So I'm going to look at part B here. All right, so I'm going to actually duplicate part A. So right click on, these, all right, right click on this and pick this move or copy. All right, so I'm going to create a copy. And I'm going to actually move to this, book. All right, book 3. This is actually my, this is the one I'm working on. All right, I'm going to move this to the end. All right, so let me click OK. All right, so you see that I can rename this. Okay, so I'm recycling what I did for, part A, and I'm going to use it for part B. All right, so this is not necessary. So let me just delete this. All right, and this is now number 2, part B. All right, so let's see what fun we're going to have for part B. All right, so part B, this is saying the model in part A includes cost of goods sold, but not SG&A. All right, you guys know the SG&A, the selling, general, and administrative expenses. All right, so suppose the company has $200 of this expenses every year, regardless of the level of sales. All right, so now can you actually change the model to accommodate this new assumption? Okay, and what is the enterprise value? What's the market value of equity, and so on and so forth. All right, so how do you incorporate SG&A? Well, that's going to enter into your income statement. All right, so I'm going to actually insert one row here. Okay, and I'm going to look at SG&A expense. All right, so I'm going to look at, this is actually $200. Okay, it's actually $200 every year, so it's kind of unrealistic. All right, so it's $200 every year. Okay, so you have $200, and right now it does not change our valuation numbers. Okay, because we have just added the one row, and we have not changed our formula for the profits before tax. All right, so now I'm going to actually look at the profits before tax, and this time I need to knock off the SG&A expenses. These are pre-tax expenses. Okay, so that is the number now, 174, and I can copy this across. Okay, so everything is copied across, everything is updated, and you see that the enterprise value is 708, the market value of equity is 468. So that is very quick. All right, we're recycling based on what we did for part A. All right, part C, this is saying, can you actually build a data table and can you actually look at the sensitivity of the SGA, of the equity value to the SGA? All right, so SGA should vary from $0 to 600 per year. All right, so what should we do? How about we just replicate or make a copy of this part? All right, I'm going to actually move it to the end. All right, and I'm going to call this part C. Okay, I'm still recycling from the existing work I did for part B. All right, so now I'm going to look at SGA expenses. All right, SGA expenses, this is actually in the income statement, and this is 200, and so everything is constant. So I'm going to actually, get ready for data table. Okay, so I'm going to say constant SGA expense. All right, so right now it's actually set at 200. So now I'm going to actually verify there's a link between SGA expense and the enterprise value. In other words, if I change this number, then the enterprise value should change. So to achieve that, I just need to make one correction in what we did for part B. All right, so look at the SGA expense that's in cell C48. So I'm going to scroll up. I'm going to replace this constant with C48. And actually, I'm going to lock this down so that I can actually copy this across for all the other years. Okay, so now let's see, there's a link. All right, so what if I change it to 100? If I change this to 100, yes, all the numbers, they actually change. So that's good. There's a link. Now I'm going to build a data table. All right, so I'm going to look at SGA expenses. Okay, I'm going to look at 0 to, all right, the question says you should look at 0 to 600. It doesn't mention the increments, so you have a little degree of freedom here. So how about we just add 100 each time? Okay, so from 0 to 100, 2, 3, 4, 5, 6. All right, and now I'm going to look at, this is the sensitivity of the equity value. So that's this number here, okay? And now I can actually make my data table work. All right, go to data, what if data table, and so the row input cell is the SGA expense, and that's the number we use when we calculate the market value of equity, and the column input cell is blank. Okay, so that is the benchmark case for part A, which is when there's no SGA expense, the equity value should be 1,357. So we're done with part C. All right, so let's look at part D, and this is saying, get back to part A and suppose the fixed assets at cost follow the following step function. All right, now you want to actually incorporate this function into the model and solve for the market value of equity. Now this is really confusing. So I'm going to actually go back to part A and make a copy, okay? And I'm going to move to the end, all right? So this is now part D. Okay, so now let's look at what do we have. All right, this is saying we should actually look at the fixed assets at the cost. So now the fixed assets at the cost is actually taking this, nasty functional form. So fixed asset at the cost, this is what we did for part A. It's actually adding up the net fixed assets and the total depreciation, okay? So if we're going to actually look at the fixed assets at the cost, all right, so I'm going to, first of all, I'm going to model this step function here, okay? And fixed asset at cost, and you have total depreciation, and so your net fixed assets, that part should actually change as well, because if you're changing the fixed asset at the cost, then your total depreciation and net fixed assets, they may actually change as well. All right, so I'm going to look at this one here. This is fixed at cost for year one. All right. Now this is saying if the sales is actually less than 1,200. All right. So the sales is 1,100. Yes, it's less than 1,200. So what I'm going to do is I just want to make this a little easier. All right. So what I'm going to do is I'm going to do this, judgment by myself. The sales right now is actually 1,100. So this is actually applying the first part of the step function. So that's just going to be equal to 100% times sales. All right, so that is the fixed assets at a cost. Okay, so now you notice that these two numbers, they even don't add up to 1,100. Okay, so what you need to do now is actually, instead of looking at the net fixed assets as 77% of sales, you would have to actually do it the other way around. You cannot make one assumption about the fixed asset at cost and another assumption about the net fixed assets and another assumption about the total depreciation. Okay, so because if you make these three assumptions at the same time, then the total depreciation plus the net fixed assets, they may not be the same as the fixed assets at cost. So what I'm going to do is I'm going to actually change this formula here. So that's going to be equal to this fixed assets at cost minus the total depreciation. All right. So that fixes my first year. Okay. All right. Let's keep going for the second year here. Second year, let's look at sales. Sales is now $1,200 and $10. So we're applying the second step function here. The second step function, this is saying the fixed asset cost should be equal to 1,200 plus 90% of the difference between sales. All right, that's the difference between sales minus the 1,200. Okay, now some of you will ask, this is not robust. Yes, it's not robust. If you want to have a robust formula, you can actually use the if function. But I don't want to confuse you with the if function at this point. So I'm just going to do this manually. All right, so this is the sales, and this is the fixed assets and the cost. So I'm going to actually copy this formula across. Okay, all right, so now I'm going to look at year 3 here. And this is looking at sales of 1,331. So we're still in the second step function here. So how about I just copy this across? Okay. And I should also copy these across. All right. So yes, I'm done with the first 3 years. All right. So let's now look at year 4. Year 4, this is actually when the sales is crossing 1,400. So we're going to apply the last step function here. So that's going to be equal to 1,380 plus, all right, 80%. Okay, multiplied by the sales, which is whatever sales you have. We know it's above 1,400 minus 1,400. Okay. So that formula is this, okay, and I should fix this part as well. All right, and I'm done with year 4. So year 5, I know the year 5 sales is above 1,400, so it's the same step function. So let me copy this across, and I'm going to copy this across as well. Okay, so does that give us the answer? Yes, 2,858.14 versus 2,618.14. So that's good. All right. So all the little things you have to consider. You can't just consider the fixed asset at a cost without changing the formulas for net fixed assets. As we're saying, some of you may ask me, why do you change the net fixed assets at a cost? Why don't you change the total depreciation? Well, total depreciation is purely mechanical. All right, so you can't change that part. All right, so part E. Let's look at back to part A again. All right, so I'm going to actually, make another copy here, and I'm going to move this to the end. So let me call this part E. All right. So I'm always trying to save a little effort or save a little time here. This might be very important, in your exams. Okay. All right, so now this is saying make two changes in the model. First of all, that is the plug. All right, and keep cash constant. Okay, so let me make this change. Cash is constant, so let me just copy this across. And if that's the case, I need to actually solve total assets first. So that's equal to the summation of, the cash and current assets and net fixed assets. All right, so that is this number here. And now I'm going to manually balance the balance sheet. All right, so, and now I actually need to look at debt as the plug. So debt is the plug, so I'm going to actually, I'm going to actually back out the debt from the total liability plus equity minus current liabilities minus equity minus total accumulated retained earnings. Okay, all right. So all the numbers, they have changed. All right, and so that is good for for the first year. All right, I'm going to make the changes for all the other years in a second. But let's look at what else do we need to do. All right. And suppose the firm has 1,000 shares and decides to pay in year one a dividend of 15 cents per share. All right. And also, suppose the firm wants the dividend per share to grow in subsequent years by 12% per year. All right. So now we're looking at dividends. Okay. So instead of looking at the dividend payout ratio, we're going to say the dividend in year one is going to be 1,000 shares times 15 cents per share. So immediately we know that's going to be 1,000 shares times 15 cents per share. Okay, whatever that number is, that's 150. And then it's going to grow at 12% per year. So that means the dividend in year two is going to be dividend in year one multiplied by 1 plus the dividend grows, which is 12%. Okay, so I can copy this across for all the other years. All right, so all the numbers they changed, and the final thing I need to do is actually make the changes for the debt as the plug for all the other years. So what should I do? Well, I should probably copy everything here. Okay, this is year one, and I have all the numbers, all the formulas corrected. So let me just copy this across. Okay, all the numbers are changed. All right, you see, I'm fairly familiar with all this. And what else do we need to do? There's nothing else we need to do. Okay, so yes, the market value of equity is 1,357.90, and the price per share, that's going to be market value of equity over number of shares, which is 1,000. So that's $1.36. Okay, so you notice that this is fairly complicated, but you give me a little tweak here in part E. This is actually solving debt as the plug. So immediately I realize that I'm actually going to change my debt formula here. Look at this formula. We manually balance the total liability plus equity the same as total assets. Okay, and cash is the same. Or actually, there's a little problem here. Yes, is it? Cash is the same. So Excel is actually automatically adding $1 each time when you copy this across. This is a little nuance Excel is giving us. So I'm going to actually manually change this. Okay, all right. So the number does not change that much. Okay, and let's see whether this actually coincides with the all right, 3578 or 79. That's good. All right, so the cash is all the same. The debt is the plug. All right, so that part is good. And the dividend is actually starting at 150 in year one, grows 12% in year two, and so on and so forth. All right, So everything's good. All right. I hope this is useful.